Most people spend 6 months looking at rental properties before they make an offer. And in that 6 months, they look at everything except the numbers. They drive by the house, they check the neighborhood, they look at the photos, they ask their realtor if it's a good deal, they watch a YouTube video about passive income. What they don't do is sit down with a spreadsheet and run the actual math. And then they buy the property. And 6 months after that, they call me wondering why they're not cash flowing. I've been a commercial and residential broker for 23 years. I own single-family rentals and a 100-unit apartment complex. I have seen this exact scenario play out hundreds of times. Today, I'm going to show you how to stop guessing and start analyzing. By the end of this video, you will know exactly how to evaluate any rental property in under 20 minutes. Not conceptually, actually, with a spreadsheet, with real numbers. The same framework I use on every deal that comes across my desk. Let's get into it. Here's what most beginners get wrong from the start. They look at the listing price and the advertised rent, and they do one calculation: rent divided by price. They call it a rent-to-price ratio. They heard somewhere that 1% is the magic number. That's not underwriting. That's a gut check at best, and it will get you into trouble. Real underwriting comes down to 5 numbers. Just 5. Once you understand these 5, you can evaluate any residential rental deal and most small commercial deals in the time it takes to drink a cup of coffee. Number 1, gross rental income. This is the total rent the property could generate if every unit were occupied every month of the year. Not what it's generating now, not what the seller says it generates. What it would generate at full occupancy based on current market rents. You get this from Zillow Rent, Zestimate, Rentometer, or by calling a local property manager and asking what similar units are renting for. You use market rents, not the lease that's already in place. Number 2, effective gross income. Take your gross rental income and subtract for vacancy. More on vacancy assumptions in a minute, but the short version is, if you're underwriting at 0 vacancy, you're not underwriting, you're hoping. Number 3, net operating income, or NOI. This is your effective gross income minus all operating expenses. Taxes, insurance, maintenance, property management, capital expenditure reserves, utilities, if any, are owner paid. NOI is the single most important number in real estate investing. Everything flows from it. Number 4, debt service. This is your mortgage payment, principal and interest. If you're paying cash, skip this one. Almost nobody is paying cash on their first deal. Number 5, cash flow, NOI minus debt service. If this number is positive, the deal cash flows. If it's negative, you're subsidizing the tenant every month. Some investors do that intentionally, betting on appreciation. That's a different strategy and a different conversation. But if you're expecting cash flow, this is the number that tells you whether you have any. That's it. 5 numbers. Write them down. Now that you have your 5 numbers, you can calculate the metric that actually tells you whether a deal is worth your capital. Cash on cash return. This is the metric I care about more than any other on a leveraged residential deal. Here's the formula. Annual pre-tax cash flow divided by total cash invested. So if your property generates $400 per month in cash flow, that's $4,800 per year. If you put down $60,000 to buy it, down payment, closing costs, any immediate repairs, your cash on cash return is $4,800 divided by $60,000. That's 8%. Is 8% good? Depends on your market, your risk tolerance, and what else you could do with that $60,000. But as a general benchmark, below 5%, and you're barely beating a high-yield savings account while taking on landlord risk. 5 to 8% is acceptable in most markets. Above 8% in a stable market is strong. Now here's the important thing. You have to use your numbers to calculate this, not the sellers. The listing will show you a pro forma. Every pro forma I have ever seen from a seller or listing agent has been optimistic. Not fraudulent, optimistic. They assume full occupancy. They assume low maintenance. They sometimes leave out property management entirely because the current owner self-manages. The moment you take over, you are no longer the current owner. You are a new owner with a new property in a market you may not know well yet. You need a property manager. You need maintenance reserves. You need to underwrite for the real world, not the seller's best case scenario. Run your own numbers, every time, without exception. This is where I see the most expensive mistakes made. And it's not complicated. People just use the wrong numbers. Let me give you the assumptions I use. These aren't theoretical. They're what I've found to be accurate across my own portfolio and the deals I've brokered over 23 years. Vacancy, 8%. That's 1 month per year of lost rent. In tight markets with low supply, actual vacancy can run lower. In softer markets or with older properties, it runs higher. 8% is a conservative starting assumption that works in most markets. If you're underwriting at 2% or 3% because the current owner has had the same tenant for 4 years, you're setting yourself up for a bad year the first time that tenant leaves. Repairs and maintenance, 5 to 8% of gross rent annually. For a newer property in good condition, use 5. For anything over 20 years old, use 8. For anything that hasn't had a major system replaced in a long time, HVAC, roof, water heater, plumbing, use 10 and build a specific capital reserve on top of it. Capital expenditure reserves 5 to 10% of gross rent annually. CapEx is not maintenance. CapEx is the roof, the HVAC, the water heater, the windows. These things don't break every year, but when they break, they're $5,000 to $15,000. If you're not reserving for them monthly, you will be caught flat-footed when they hit. Property management, 8 to 10% of collected rent. Even if you plan to self-manage, I mean this seriously, if you underwrite assuming zero management cost and then you get a job change, a health issue, or a second property, and you suddenly need a manager, you just destroyed your returns. Underwrite the real cost. If you self-manage, that 10% becomes profit. If you don't, you're covered. Insurance. Get a real quote. Don't estimate this. Insurance has gone up significantly in most markets over the last 3 years. Call your agent or use an online quote tool. Use the actual number. Property taxes. Check the county assessor's website for the current assessed value and mill rate. And here's one people miss. If the property has been owned by the same person for a long time and the assessed value hasn't kept up with market value, the taxes will reassess after you buy it. In some states, significantly. Factor in the post-sale assessed value, not the current tax bill. When you add all of this up, total operating expenses on a residential rental typically run between 45 and 55% of gross rental income. If the seller's pro forma shows expenses at 25 or 30%, that's not a good deal. Those are missing expenses. Now let's talk about cap rate, because cap rate is the number everyone talks about, and it's also the most misunderstood number in real estate. Cap rate is simple. Net operating income divided by purchase price. If a property generates $30,000 in NOI and you pay $500,000 for it, your cap rate is 6%. Here's what cap rate actually tells you. It tells you the unlevered yield on the asset. It tells you what return you'd get if you paid all cash. It's useful for comparing properties in the same market. It's not useful for telling you whether a deal cash flows with your specific financing terms. Two investors can buy the exact same property at the exact same cap rate and have completely different cash-on-cash returns because one financed at 5% interest and one financed at 7.5%. Cap rate is a property metric. Cash-on-cash is an investor metric. You need both. The second thing people get wrong about cap rate is using it to compare deals across markets. A 6 cap in Dallas is not the same as a 6 cap in Cleveland. In Dallas, you might be getting modest cash flow, but strong appreciation and a growing rental market. In Cleveland, you might be getting strong cash flow in a flat or declining market. The cap rate is the same. The investment thesis is completely different. Use cap rate to compare similar properties in the same market. Use cash on cash to evaluate whether a specific deal makes sense for you, with your financing, with your capital. And for what it's worth, on residential deals under $1 million, most serious buyers aren't even leading with cap rate. They're leading with cash on cash and GRM, gross rent multiplier. Cap rate becomes more important as you move into commercial multifamily. All right, Here's how you put this all together in under 20 minutes. Step 1, get the basics. You need 4 pieces of information before you open a spreadsheet: the asking price, estimated market rent, property taxes, and insurance estimate. You can get the first 2 from the listing and rentometer. You can get property taxes from the county assessor's website. You can get an insurance ballpark from a quick online quote. This takes 5 minutes. Step 2, build your income line. Multiply monthly market rent by 12. That's your gross rental income. Subtract 8% for vacancy. That's your effective gross income. Step 3, build your expense line. Take effective gross income and subtract the following: property taxes, insurance, 8% for property management, 8% for maintenance and repairs, 8% for CapEx reserves. Add them up. That's your total operating expenses. Step 4, calculate NOI, effective gross income minus total operating expenses. Step 5, calculate debt service. Use a mortgage calculator. Plug in your loan amount, interest rate, and term. Get the monthly payment and multiply by 12. Step 6, calculate cash flow and cash on cash. NOI minus annual debt service equals annual cash flow. Divide by your total cash invested to get cash on cash return. If the cash on cash is above 6 or 7% with these conservative assumptions, the deal deserves more of your time. Schedule a showing, order an inspection, talk to a local property manager about actual rents and vacancy in that specific submarket. If the cash on cash is below 4 or 5%, put it back and keep looking. Not every deal pencils. Most deals don't. That's not a failure. That's discipline. Here's the part nobody makes a video about. Most deals don't pencil, and that's fine. Last year I looked at over 40 deals. I bought 2. The other 38 were not bad properties. They were not scams. They were perfectly reasonable assets at market prices that simply didn't meet my return threshold. When you run the analysis and the numbers don't work, there are exactly 3 options. Option 1, walk away. This is almost always the right answer. The market will produce another deal. Your capital is finite. Deploy it where the math supports it. Option 2, negotiate. If you understand the deal well enough to know what price makes it pencil, you can make an offer at that number. Some sellers will take it, most won't. But the ones who do are usually motivated, and motivated sellers make for good deals. Option 3, re-examine your assumptions. Sometimes a deal that looks thin has upside that the current owner isn't capturing. Below market rents, vacancy that can be reduced with better management, expenses that can be trimmed. If you see a legitimate path to improving the NOI, model it. Be conservative about how long it takes and how much it costs. If it still pencils after that analysis, it might be worth pursuing. What you do not do is talk yourself into a bad deal because you like the neighborhood, or because you've been looking for 6 months and you're tired of losing, or because your realtor says it's a good investment. The spreadsheet doesn't have emotions. Use it. That's the framework. 5 numbers, 1 key metric, a 20-minute process you can run on any deal from your kitchen table. The link in the description has a free rental property analyzer. It's the spreadsheet version of everything I just walked through. Download it, plug in your next deal, and see what the numbers say. If this was useful, subscribe. I publish every week. Every video is built around the same idea. Let's look at actual deals and figure out whether they work. Next week, I'm running a live underwrite on a duplex I'm currently evaluating. I'll show you the numbers and I'll show you my decision, including if the answer is no. Brick by brick capital. See you next week.